Welcome to Real Wealth, Real Health, the show that empowers you with insights, information, and inspiration to achieve your version of financial wellness. Learn how to balance living a full life today with planning for the future. This podcast is brought to you by Alpha Investing, a real estate-centric private capital network that provides exclusive investment opportunities to its members. And now, here are your hosts, Ada Piederico and Daniel Kogut.
Hello, and welcome to another episode of Real Wealth, Real Health. Today, our guest is Benjamin Kogut. Ben is a partner and head of investor relations for HJH Investments, which protects and then grows investor capital through commercial real estate syndications. The investments include industrial buildings, shopping centers, and office buildings, which are typically anchored by high credit tenants with long-term leases throughout the U.S. HJH has over $350 million in assets under management. Ben is passionate about educating investors about passive income investing and has written an ebook called 5 Things to Consider When Investing in Commercial Real Estate Syndications. Ben is based in Austin, Texas, and has an MBA and CCIM certification. We talked to Ben about his passion for commercial real estate, why he loves to teach people about investing in real estate, and he dives into his 4 cash rules. We also get in depth into the asset classes of commercial real estate that he and his company offer investors, and how the changes in consumer behavior have shaped the landscape, but not in the way that has caused many to fear certain sectors like retail. There's a lot to learn about diversification of real estate for a personal portfolio, how to win deals in a challenging market, and why commercial real estate continues to be an important asset class for any investor's portfolio. Ben, welcome to the podcast.
Thanks, Adipia. It's an honor to be here.
Yeah, I'm so excited for our conversation today. It's been, it's mid-June, so we're midway through 2021. How that happened, no one knows. But we were just saying how, at Alpha, we've been so busy with back-to-back deals all year. And I know that you've been really busy in what you do back-to-back all year. And I just really wanted this conversation to be about, not about like your background, how you got into it. You're super passionate about real estate investing and like educating people, as are we, and just like a nice conversation about the asset classes that you're working in, what you're seeing, what we've been seeing, and maybe we can gaze into a little crystal ball for the second half of 2021 at some point.
I'm in. Let's talk. This is great.
Perfect. All right. Well, how about let's just start with how, we know what you do at HJH and you've been doing it for a while, super successful capital raiser, but how'd you get into commercial real estate and how did you specifically get into, being a capital raiser?
Sure. Yeah. Got into commercial real estate back in 2005. First as a commercial real estate broker, went and got my CCIM and was really inspired by some mentors of mine. So I've always believed that it's better to copy genius than create mediocrity. And so I have made it a point to surround myself with people who are further down in their career, who are successful. And I've always looked for ways to learn from them. And this is before, podcasting and social media was a thing. And I was just doing it in real life, just very aggressively trying to connect with people who were successful and learned as much as I could from them. And so they guided me down the path of, getting my CCIM. And then I got my MBA back in 2011. And, surrounded myself, went to work for a family office here in Austin, Texas, handling a very large portfolio, a variety of different types of assets. And then it was my time, to follow my dream, which was to be an entrepreneur. And so back in 2015, I started a brokerage company, a development company, and started personally investing in commercial real estate. And learned that development was not for me. It is a rough business, and so that's okay. We survived that, but realized, okay, that's not for me. And really it was, what I learned was the benefits of cash flow and predictable cash flows and the unit economics of the fundamentals of the tenants that occupy the real estate that we like to acquire. And once I really understood that, I started actually as an investor with HJH back in 2017 and built a relationship with the CEO, a guy named Corey Harkleroad. And after chatting with him, and he started the company, and after chatting with him for about a year, he made me an offer I couldn't refuse to join the company as head of the raising capital and investor relations and that sort. And it's been the best thing I've ever done.
Wow. So when you started working at the family office, because you got your CCIM, so actually let me back up and ask for clarification, what is a CCIM?
CCIM it's a commercial real estate designation. It's a series of educational courses. They call it the MBA of commercial real estate, and it's very technical, and it was really a good education for me early on in my career.
Oh, got it. Okay, cool. Yeah. So like you go into family office, which some people know, we work with some family offices as well, but a lot don't. I mean, the way that they invest is so different than the way maybe a professional invests or I invest, and they have access to different kinds of opportunities. So what was it about real estate for you that, you just really locked in on that?
I think that the scalability of it was really attractive to me. The inflation hedge, that it's an alternative asset as opposed to going in the stock market, that it's historically continued to appreciate in value. And, there's always going to be dips here and there, but frankly, that's still held to be true. And I don't see any reason why that won't continue. And it's something that has allowed me to, never stop learning about. So.
Yeah, that's fair. And you're both never stop learning. So the, Zen mind, beginner's mind comes up for me when you say that. It's a fabulous book, but it's also just a mindset. And you also love to teach. So let's talk about, there's something that I know you wanted to share with us, and then you wrote an ebook that we'll link to in the show notes for people, but tell us a little bit about the teaching part, why that's so important to you, and also how that's helped you do what you do.
Yeah, frankly, before I started raising capital and teaching people about commercial real estate and passive income and our niche, I didn't know that I enjoyed teaching. So now I know that I enjoy teaching. It's become a passion of mine. Just it's biblical for it's better to teach a man to fish than to give a man a fish, right? And so that sits with me. And turns out my dad is a teacher. He is a dentist, but has now since moved on from dentistry to teach dentists. And he's actually gone back to school to become an architect. That's a whole other story. But it's just personally rewarding to see people grow in their own personal journey and to be able to help them reach their financial goals probably sooner rather than later. And so I know you enjoy teaching as well. And it's honestly, my career is better than anything I could have ever dreamed of, that I get to help people reach their goals. And so all these things are, building up together, and I'm just having the time of my life right now.
You can tell there's a huge smile on your face. I know a lot of people will be listening, but it's true. There's a lot, we talk about this a lot with like helping people reach their goals and helping them understand the role of commercial real estate in a portfolio. And I often talk about how I got my start working in a bank when I was 18. I was on, financial planner path, and, we don't learn, not even securities courses today really talk about real estate outside of like 2 pages in the manual about a REIT. So when I discovered real estate, which was a lot later, it was shocking. And at the same time, one of those things where it's never too late to get into it, I've found. So I don't know what you think about that, but it's definitely, it's such an important thing. And it excites me. It excites us at Alpha too, to just like, you get there so much faster with your goals.
Absolutely. It's never too late to learn. And so, to that point, I decided to write that short ebook. And so maybe I'll share a little bit about that. One of the things that people kind of get their eyes open about is the 4 rules of cash. Have you heard of it? So have you ever heard of Solomon's 4 rules of cash?
I have not.
Okay, so it's in my ebook, hjhinvestments.com/book. It's free. Go check it out. It's real short. But the 4 rules of cash, they sound really simple, but there's some depth to it. And that's what I like about simple lessons. And so rule number one is more cash is better than less cash. Okay, easy enough.
Yeah.
Cash sooner is better than cash later, right? Now, rule number three, less risky cash is better than risky cash. And rule number four, drum roll, never run out of cash.
Yes.
So we go into a little bit more depth on what those rules mean and how to balance those out when you're looking at different alternative investments. And so, yeah, I just wanted to kind of share with you some of those rules. What do you think about those?
I'm thinking about them and I'm like, yeah, makes sense. And at the same time, I'm thinking how hard it is to have cash on hand consistently, whether it's because it burns a hole in your pocket because you want to put it to work and you don't want cash drag, whether it's you're waiting for, let's say, a liquidity event, or you haven't built up enough of a portfolio where you're getting, whether it's dividends or distributions. And so it's really logical, and yet it's very challenging is what comes through for me.
Nice. Yeah, that's right. And they all have different consequences to your investment thesis as you're moving forward. Would you rather have cash now or cash later? Why? What are the pros and cons to making your decisions based on these types of rules? And so, yeah, there you have it.
Yeah, it's especially now, right? Like we were talking about all these deals, and I know like Dan wants to jump in and talk about deals, so and asset classes. So I think we should just dive in because let's put that cash to work.
Well, I was going to say before that, for me personally, it's this like kind of funny story, which is or funny setup, which is completely irrational, which is like, I really want liquidity at all times. I get really excited when I have that liquidity event, but then immediately my brain turns to how do I get all of this cash somewhere else as quickly as possible? And then like, you're just in this internal conflict about how you feel about it in perpetuity. And so yeah, quick insight into how my brain works, but admittedly not rational.
Fair enough. Well, at least you know that about yourself, and that's a good step.
Yeah, right. That's very true. Realization is step one. So let's transition now and talk about investing. Ben, maybe you just want to chat a little bit about the different asset classes, deal types you're interested, why you think they make sense, et cetera, and then we can kind of go from there.
Sure. So at HJH Investments, we coincidentally just closed on our 59th acquisition last week. And so our niche is buying shopping centers, office buildings, or industrial properties. So those are the only three property types that we acquire. And what they all have in common is at least 30% of the tenancy is BBB credit or higher, with more than 5 years of term remaining on the leases, and we have to acquire it better than a 9 cap. So in other words, high credit tenants, long-term leases, better than a 9 cap. If it checks those boxes, then we make an offer on it. We do research every day with our acquisitions team, looking at between 800 and 1,500 deals every week. Out of that, about 16 properties will fit in our criteria. And out of that, we'll make 3 to 5 offers a week on different deals. And 2 out of 3 deals that we put under contract will pass our due diligence process. So it's been it's a large funnel that we are very, very, very specific about what we're looking for, kind of a needle in a haystack kind of situation. And that's our formula, and we're sticking to it.
And how have you seen, the portfolio change, or what have you been seeing, I guess since COVID, but then, I think in our world, in this real estate world, things have seemed to shift a little bit in 2021. The mindset's a little bit different than it was, on the back end of 2020. I would love to get your thoughts on that.
So sure. So the 3 different asset classes, the easy answer is we haven't been able to find any industrial properties. So the industrial market has been extremely competitive. We have been buying retail and office. Office in particular has been fantastic for us. We've been able to pick up suburban office buildings throughout the Midwest that, again, they're occupied by high credit tenants with long-term leases. And we found that there were many owners who were motivated to sell in the pandemic because some people think that, office people are never coming back to the office. Well, that's not what we think whatsoever. In fact, we're seeing the opposite. People are coming back to the office. We are signing new leases. We are buying also medical office buildings, which have had hardly any issues whatsoever throughout COVID. And so, we struck while the iron is hot. We found people who were motivated, oftentimes for reasons that were unrelated to the actual asset, that were looking to get rid of the property. And so we're happy to buy it. We're long-term owners, long-term investors. And so we understand that there's going to be cycles in the office market. And as long as we buy it right, the right price per square foot, the right locations, the right tenancy, then we're going to be just fine. And it's proven to be correct. And so there's that. And then retail, there's some people out there that think that retail's dead, right? Amazon and this and that. Well, the secret's out about Amazon. I mean, we all know that there's online, retail and e-commerce and all that good stuff. Well, what's happening is that shopping centers, frankly, have pivoted and transformed in the way that they look. Like, for example, 10 years ago, shopping centers would be a place where you go shop. And by the way, I'm not talking about malls, enclosed malls. That's a different category. So we just bought a grocery anchored shopping center. We believe that, yes, there is going to be grocery stores that sell online and deliver and all that. I think a lot of it, frankly, is you order it online, you can pick it up and keep moving on with your day. But then like the shopping centers are, restaurants and medical and bars and, service-oriented businesses that frankly cannot be moved to e-commerce. And so we have diligently looked for opportunities like that where, if we can buy it better than a 9 cap, then we're going to, go through the DD process and then eventually raise the capital for it.
So if you're buying it better than 9 caps, which is a number that, when I hear it, seems very high to me, not just because in real estate it's very high, but even within that asset class. Is it because you're finding distressed deals, like the grocery anchored retail, the medical office, industrial, as you mentioned, have all become so popular since COVID because they're resistant to the things that you have challenges with typically when you have a commercial property and tenants and service providers, right? And so, given that, like, are you seeing distressed deals? Is it just that you think there are less people within, the retail or suburban office class, even within the niche that you're operating with? Like, how should we think about pricing in your space when, our reference point for a lot of investors is often multifamily?
Yeah. So, since we do research every day, we know exactly what the right cap rate is. And kind of like I alluded to, the cap rates we're getting are because the sellers are motivated. It's not because there's anything wrong with the properties. In fact, we often do very little value add to the properties. They're mostly stabilized with certain exceptions. And so the way that, what I can share with you is some of our strategies on winning deals that might be, beneficial to you and your listeners. And so I'll just kind of fire them off real quick on how we've been able to win deals. And so number one, if it's on the market, so we get a lot of deals off market directly because of our reputation, but let's just say it's on the market. We will make an offer on that asset within 24 hours of it hitting the market. So we are oftentimes the first offer a seller will review. And so I don't know why, there's probably some psychological reason for it, but more often than not, the first offer wins the deal. So that's a tip that anybody can use. Make the offer right away. That's number one. Number two, we're going to go ahead and preemptively send them a list of references. So here's a list of everybody we've done business with. Call anybody on this list, and they will tell you that we at HJH, we do what we say we're going to do, right? Number three, we promise the seller or the broker, whoever we're talking with, that we will personally, physically be on site within 2 weeks of being under contract. So that requires a lot of travel. I just got back last week from quite a bit of travel in Detroit and Indiana, and that's a lot of hard work. And so when we go out to these secondary markets that they are harder to get to, that kind of that narrows it down and makes us look a little bit better because we're promising them that we'll be there on site. And that's what we do. And number four is just real simple. Do what you say you're going to do at all times. Integrity. And so I guess the bottom line takeaway message that I want people to know is make offers. Make the offer. If they want, a price down below here, but you're willing to pay a price, lower or whatever it is, just make the offer and let them, counter or tell you no or however they respond. It doesn't matter. So make offers.
So at the point that you're making an offer, have you gone through any level of diligence or asset level evaluation, or you're just making an offer and then if you get to that next step, that's when you're then going through the process of evaluating the transaction?
So typically we will have reviewed a rent roll, at least the basics of it, whatever is in the offering memorandum. And we'll tell the seller, hey, listen, if everything checks out the way your OM is, great, we'll do it at this price and these terms and we'll move forward. And then later on, we're going to dig into it. And if we find things that are discrepancies or anomalies, then we're going to have to cross that bridge when we get there. So really the clarity of the OM is super important so that we don't have to get to a situation where there's, any modifications down the road. And normally there's not, but, we'll tell them right up front, hey, this is what we'll do. We're going to do this deal. And that's what we do.
And so you said, I think earlier, you close 2 out of every 3 deals. Is it that you have under contract or that you agreed on? Like, what was that for?
Yeah, the point of that was that not every deal passes our DD process. In fact, 1 out of the 2 deals we reviewed last week did not. We got on site, and frankly, the deferred maintenance and it was just not nearly as good looking as what they made it look like in the photos. And so we real swiftly said, hey, this isn't for us, and we're moving on.
Got it. Yeah, it's a really interesting strategy, which is why I wanted to kind of better understand it and have you articulate it, right? Because, you think about the process we typically follow where we're going to go out, we're going to visit the property and tour it like before we're putting in the offer, before we're going on the contract, right? And, if a deal does become marketed or just that time gap allows the opportunity for a lot more people to come in, but that's, the way that it's, historically been done in the space. And so that's how people do it. So it's interesting to hear how you guys are kind of getting around this problem that we're seeing right now, which is deals that are on the market are going at substantial premiums oftentimes to, where people expect these assets to trade. And because of that, deals look less interesting, on paper. So yeah, really interesting that you guys were able to kind of find a workaround for yourselves.
Yeah, it's anybody can do it, really, frankly. Just get out there and make, know what you're looking for. That's really what's super critical, so that when you see it, you can swing for it and hopefully the seller is motivated enough to go for a price that works for our business model, at least.
Yeah, it's fantastic to hear. And it's also such a different asset class. Like Daniel said, a lot of people are used to multifamily. They might hear a little bit more, invest in senior housing when they work for Alpha. And, I just wanted to cover one thing really quickly, because you mentioned, and I know I've been really curious about this, is the grocery anchored retail and like all of these changes. Because when you said Amazon, I thought industrial, and, the grocery anchored, not the mall. Can you talk just a little bit more about that? So for people listening, they're understanding, because I know when I see retail, it's like a reflective, oh, I don't know, that's retail. Like it, even being who I am, knowing what I know, it's an interesting, just like a knee-jerk reaction. And so the only way to get around reflexive reactions is to be informed. So could you talk a little bit more about the retail space?
So I think looking at the unit economics, AKA what are the widgets that are being sold, and looking at what is the trend line for those types of things. So one similar example would be Best Buy. If you had asked me 10, 15 years ago, while Amazon was really, and e-commerce was on the up and up, I would have said Best Buy would be out of business by now, right? Because anything in the Best Buy store, you can buy online, literally everything. And so why are they, if you look at their stock price, it's super high. Why? It's because they were smart enough to pivot in their business model. And what I mean by that is you go in there and you'll see a Sony TV and a Vizio TV and a Samsung. And so all of those companies are basically renting space to put their TV on the wall. Or there's like a mini Apple store inside of it. Or there's even an aisle where there's Amazon products. And so they pivoted, and now they have, fantastic sites spread out around the country where people can go buy their product online and come pick it up in the store. And so we are seeing this time and time again with retail. Frankly, I think shopping centers should be rebranded to, like I don't know, a service center or something like that. But service center has like a car connotation to it. But, except for grocery anchored, I mean, most people aren't really shopping. They're going to get their nails done. I mean, just drive around wherever your local city is and look at who are actually occupying the spaces of the retail shopping centers around you. And you'll know exactly what I'm talking about.
Yeah, that's a really good point, especially as, well, I'm in California. I know you're in Texas. We're about to be allowed outside again and like be actually able to like go and do these, to kind of do that research. I think that's important for people to get a feel for it. You're right about what is in those spaces. I wanted to touch back on this because wasn't Amazon in a bidding for, was it JCPenney or somebody that was about to go? I think it was JCPenney that was in bankruptcy, and there was talk about Amazon buying them and becoming the strategy that you mentioned about Best Buy, how they've basically become a retail footprint distribution center. Do you know what happened with that, or if that would have even been a good strategy for Amazon to have more of a physicalized kind of retail presence?
I don't know that specifically, but I do know that, they bought Whole Foods, for example, which is an Austin-based company, to expand their footprint. And I don't know if you've been into a Whole Foods since Amazon bought it, but it looks very different from what Whole Foods looked like prior to Amazon's ownership of it. Also, you'll see Amazon To Go, which are smaller locations with their most popular items being sold, and so those are popping up everywhere. But really, Amazon and other e-commerce stores, that's not who shopping centers are being threatened by hardly anymore. I mean, they're, as long as it's a good location with foot traffic, and outside of California, with all due respect, people are going out and about and shopping and living their lives almost normal as it was pre-pandemic. And so we think that there's going to be almost an explosion of people who are really, really wanting to get out and try to get back to normal and catch up on all the things that didn't get to happen throughout the last, let's call it 18 months or whatever. So yeah, some thoughts like that.
Yeah, that's great. I appreciate that. And so I wanted to pivot again a little bit and talk about your personal, real estate investing or portfolio. I mean, as professionals in the industry, a lot of our portfolio is in commercial real estate, but like, what role does it play for you in your portfolio? And how you plan it, especially on a going forward basis. We know we have incoming inflation. It's already here. It's not incoming. It could potentially only get worse. How are you positioning your portfolio today, and how have you positioned it since you started investing in real estate?
So I think that diversification wins the game. So spreading my money out, frankly, I invest in every single HJH deal. And so I am very diversified amongst all of our different assets. I've invested in other people's commercial real estate deals. I've also recently invested in non-real estate deals, such as a consumer product good called It's Skinny Pasta, which was a pasta alternative that a friend of mine is running that company, and I had an opportunity to invest. So I thought, Well, that'd be a fun way to diversify, and I just enjoy the product, so it's kind of fun. And so frankly, based on the rules of cash, I am looking for cash now is better than cash later. And so what I mean by that, if you're asking what is Ben Kogut's personally, I'm looking for something that will pay me a dividend after right away, the first month, as opposed to some multifamily deals that I've seen. You put money in now and the sponsor will go and fix up the property and they'll sell it, 2, 3 years from now, and then you'll get a pop and then some. And so that's great and all, no problem with that. But for me personally, I'm looking to build my monthly passive income so that, frankly, I've recently surpassed the point where the passive income I have coming in exceeds my personal expenses. And I know, like, for a lot of people, that's the fantasy, that's the goal, right? To have, and so I'm there, and now I'm just trying to push it. And, I have a number in my head that if I achieve that, you got to have a goal, right? So I'm looking for a monthly passive income that will far exceed the amount of money I could personally spend on a monthly basis. So
yeah, that's a really good way. That's a really good way of looking at it in terms of the monthly income that exceeds your monthly expenses. I know for me, and it kind of references what Dan mentioned before about as cash comes in, you're like, oh my God, I got to get rid of it. When I have cash coming in from my passive income in investments, I'm like waiting to accumulate it a little bit more so I can invest in another syndication, at least at this point in my life, right? It's like not exactly compounding, but almost. And that's how I tend to think about it as well. And which is why I like a combination of like what you do and what we do, because in some ways, from a diversification perspective, for me, I try to balance out what will have a bigger pop a little bit down the road and what can have a more stable monthly cash flow so that I can constantly every year be investing and kind of creating a bond ladder, but with real estate syndication. So that's another way that, or at least that's one of the ways that I think about diversification within cash flowing real estate.
Anytime I have an opportunity to spend money on something fun, like a car or a boat or vacation or whatever, the thought that goes through my head is, okay, well, it's just going to slow me down from reaching my personal monthly cash flow. And oftentimes I've delayed many of the projects and fun things that I want to spend money at just because it's just not the goal. My goal is basically 2.5x what in passive income coming in versus the amount that on average I spend on a monthly basis. So if I spend $10,000 a month, just, between rent and car and life and all that, then I'm looking for $25,000 a month in passive income.
Got it. That's a good metric. That's a really good metric to think about. I'm going to have to calculate mine after. It might take me a minute on the podcast. So let's shift into this, because you mentioned something about like fun in your life. And I'm not a big spender. My husband has taught me a lot about feeling abundant by giving myself things that I like. Cause otherwise I really don't, because I'm like a little squirrel and I want to put everything away. But of course, we're living a life, and I know you have kids, you have a family. And so let's talk a little bit about, how you balance the investor with a lifestyle and finding that balance within yourself and how that like basically how you do that for your life. And I know it's important to you, so would love to have you share that with everybody.
Yeah, that balance is very important to me. And just to clarify, I don't have any kids.
Oh,
it's okay. I do have a girlfriend, and we're going down that path, but we're not quite there yet. And for me, being able to take care of other people has really just been a very important value of mine that I've learned from my parents and grandparents. And so I think that it also starts within myself. And so I know that if I have a healthy body, I'll have a healthy mind. If I have a healthy mind, I'll be able to do healthy things to take care of other people. And so I do spend a lot of time making sure that I am personally healthy, both physically, mentally, spiritually, and all those kind of things. And it's a commitment. It's a lifestyle. And, I have recently learned to meditate. And so that has really helped me get clarity on balancing all the things that pull in life. And luckily I'm an energetic guy and I just like to have fun, and, I love what I do. So it's really just a pleasure. Life has just been really fantastic for me lately, and I'm very grateful for that. And I just think that if I can help other people on their journey as well, it's just it's a gift and an honor and a privilege to be able to do that.
Oh, thank you for sharing that. Yeah, I don't know why I thought you had thought you had kids. You're always like doing so much stuff, but I love hearing that. And me, I'm big on mindfulness and meditation and finding that space to clear the mind and live in a harmonious way. I think balance can sometimes feel like static instead of it being something more harmonious, right? This idea that things in balance are fluctuating back and forth, but if you were to ever stop, it's not, the likelihood of it stopping on a flat line of balance is almost impossible. So it's like this going with the flow. I digress into some like metaphysical things, but
no matter what, the most important thing is keep moving forward.
Yes.
And when it's important to let go of things, and we have things that have hurt us along the way, we have to learn how to let things go, so that we're not dragging them around with us like luggage, and just keep moving forward.
Yeah, 100%. Yeah, that's that flow and that movement. And so it leads really nicely, actually, thank you, into the last question I would like to ask you, which is, what does wealth mean to you?
So the first thing that comes to mind would be health amongst my family and friends, the people that I love. So that's the relationships. That makes me feel wealthy. That's when I'm happiest. That, and when I am able to be outdoors, having that. I had a pleasure. My dad and my brother and I got to go to Idaho sort of towards the beginning of the pandemic, and we spent 6 days off the grid floating down a river, a pristine river. And so I was present and unplugged from social media and internet and blah, blah, blah. And that was probably the first time I really felt present, if you know what I mean, like to be there. My brain, I was not worried about any work or anything else going on out there. And so I think those are probably the two most important things. I mean, if we talked about wealth from like a financial standpoint, which is kind of like what I think most people think about wealth, then from that standpoint, it's going to be freedom. It's going to be being able to spend my time wherever and whenever I want. And that's why I do what I do, because the investing in commercial real estate, pays monthly dividends, and that ultimately allows me to do whatever I want, whenever I want. And I'm happy about that.
There it is. Well, thank you so much for sharing everything. Thanks for spending some time with us today. And it was really informative, really interesting. And we'll include links to the ebook for HJH. And if you want to just really quickly tell people where they can contact you if they'd like to get a hold of you.
Yeah, thanks so much. So again, hjhinvestments.com/book. You can also reach me there, or I'm on all the socials at Ben Kogut. Last name is spelled Kogut, and look forward to connecting with everybody.
All right. Thanks so much, Ben.
Thanks for tuning in to Real Wealth, Real Health. We hope that you've enjoyed today's episode and found it both informative and insightful. We welcome all your questions and your feedback about today's episode, and especially we welcome your questions about specific topics that you would like us to cover. So shoot us an email at podcast@alphai.com. And if you have a moment, we really appreciate ratings and reviews, as it helps us grow our online community and our interactions with you. And we'll also be linking to a number of relevant articles on topics that we might have touched on during our conversations. Some of them are broad, some of them are technical, but we're always aiming to provide information that helps you better understand the mechanics of building this healthy financial foundation, especially if you're looking to do this with real estate.